Welcome back, listeners. We're going to take a deep dive this week into some really fascinating market moves, especially after the Fed's rate cut. And, of course, we can't ignore those election results. We've got record highs. Tech and communication services are leading the charge, but there are definitely some head-scratchers in there, too.
Yeah, it's an exciting time to be watching the markets for sure.
Exactly. So let's start with the Fed. They cut rates this week, but the market didn't seem all that impressed. It almost felt like a collective meh from Wall Street. What's going on there?
You're right. The reaction to the rate cut was surprisingly muted. I think the thing is the market is a forward-looking mechanism. It often reacts to what it anticipates, not just what actually happens. In this case, a 25 basis point cut. So meaning the Fed funds rate now sits between 4.5 and 4.75% was already widely expected by analysts. So it was already essentially priced in.
So even a big move like a rate cut can get lost in the noise if everyone's already expecting it.
Exactly. And this highlights a key point for investors. Understanding market expectations is just as important as understanding the events themselves.
That's a great takeaway. Okay, but here's where I get a little confused. The economy seems to be humming along pretty well. We even saw a jump in 10-year Treasury yields, which usually indicates growth, right? So why is the Fed cutting rates if things are already strong?
That's where the Fed's dual mandate comes into play, and it's a delicate balancing act. You know, they need to keep inflation under control while also supporting a healthy job market. It's a bit like walking a tightrope.
Okay, I'm starting to see the tightrope. Can you break down the dual mandate a little more for us?
Sure, the Fed has these two primary goals: price stability and maximum employment. So cutting rates too quickly could reignite inflation, which they've worked so hard to tame. But on the other hand, if they wait too long to cut rates, it could stifle job growth. So they're trying to find that middle ground, as Chairman Powell put it.
So it's all about finding that sweet spot, not too hot, not too cold, kind of like Goldilocks in the economy.
Exactly.
Okay? But remember, economic data can be bumpy, as Powell himself admitted. Inflation, while down significantly from its peak, is still a bit higher than the Fed would like. It creates, a really complex decision-making environment. Okay, so we've got the Fed carefully tapping the brakes with this rate cut, trying to avoid overheating or stalling the economy. But let's switch gears to the election. The market seems downright euphoric about the results, sending the S&P 500 and NASDAQ to new record highs. What's driving this surge?
Yeah, the election's definitely playing a huge role in the current market optimism. I think one way to see that is by looking at the VIX.
The VIX.
Right, the VIX, also known as the Fear Index, is a measure of market volatility, and it's fallen back down to September levels, which tells us that investors are feeling less uncertain about the future.
So less fear, more excitement. But what are investors so excited about specifically? Is it all about the president-elect's policies?
Well, it's not necessarily about what's already been done. Market reactions to political events are often driven by perceptions and expectations. Investors are essentially betting on what they believe the president-elect will do and how those actions will impact the economy and specific sectors.
So it's all about future expectations, not just current realities. Sounds like trying to predict the future.
In a way, it is, and those predictions can lead to some interesting dynamics in the market. Some investors might be anticipating policy changes that they believe will benefit certain industries, like potential tax cuts boosting corporate earnings.
So it's almost like a self-fulfilling prophecy. Investors believe something will happen, and their actions in the market start to make it happen.
That's a great way to put it. And we've seen some significant moves in specific companies this week that seem to reflect this sentiment.
Right, and I think that's a perfect segue into taking a closer look at some of those individual companies and sectors that are really driving this market rally.
Hold on a second. Before we jump into individual stocks, it's important to understand the broader context. We need to dig a little deeper into the sectors that are driving the overall market trends, and then we can zoom in on specific companies within those sectors. That way, you'll have a better framework for understanding why certain companies are performing the way they are.
You're absolutely right. I got a little ahead of myself there. Context is key. So let's talk sectors. What are we seeing in terms of the big winners and losers in this post-election market?
Well, if we look at the sectors that are really shining right now, it's clear that technology and communication services are leading the charge.
Sure.
And that makes sense when you consider how much these sectors rely on innovation and future growth potential.
So investors are betting on the future of tech and communication, even amidst all this economic uncertainty.
Exactly, and a big part of that bet is on the continued success of mega-cap companies like Meta and Alphabet. Their strong performance is one of the main reasons the Nasdaq Composite is at those record highs. They're dominant players in their industries, and their ability to adapt and grow is a big draw for investors.
It's like those companies are almost too big to fail, at least in the eyes of the market.
That's an interesting way to put it. They certainly have a strong track record and a lot of resources at their disposal. But remember, even giants can stumble.
Right, no company is completely immune to market forces. But let's stick with tech for a moment. We've been talking about the big names. But what about the smaller players in the tech space? Are they also benefiting from this post-election rally?
Absolutely. Semiconductor stocks, for example, have been driving a lot of the gains in the tech sector. These companies are responsible for those tiny but crucial chips that power everything from smartphones to cars, and the demand for their products is only increasing as technology advances.
It's amazing to think about how those little chips are so essential to our modern world and how their performance can ripple through the entire stock market.
It really is. And speaking of ripple effects, we can't forget about the impact of global interconnectedness on the market.
Okay, global interconnectedness. That sounds pretty complex. Can you explain what you mean by that?
Think about the companies we've been discussing, Meta, Alphabet, and those semiconductor manufacturers. They all operate on a global scale. Their fortunes are tied not just to the U.S. economy, but to the health of economies worldwide.
So what happens in China, for example, could have a direct impact on companies listed on the U.S. stock market.
Exactly, and we're already seeing that play out. China's recent export data, which showed a significant surge in shipments, helps boost stock markets there and even had a positive impact on global sentiment. When one major economy does well, it can create opportunities for businesses and investors around the world.
It's like a giant game of financial dominoes, where events in one part of the world can trigger a chain reaction across global markets.
That's a great analogy. And for you as retail investors, it's crucial to have a global perspective. What happens in one corner of the world can have unexpected consequences in another.
Okay, so we've got tech soaring, global interconnectedness playing a role, and of course the ever-present influence of investor sentiment. It's a lot to digest. But we also need to talk about some of the companies that haven't fared so well in this post-election market. What are some examples of that?
Well, one example is the financial sector. Remember we talked about how bank stocks initially spiked after the election?
Right, on the hopes of deregulation and potential profit boosts.
Exactly. But as we've seen, that initial burst of enthusiasm can sometimes be followed by a more measured assessment. JP Morgan Chase and Goldman Sachs, for example, took a dip after JPM received a downgrade.
So it's like the market got caught up in the hype and then had a dose of reality.
You could say that. And it's a good reminder that even in a strong market, there will always be winners and losers.
Right, and that brings us back to the importance of diversification, something you mentioned earlier. Can you remind us why that's so crucial, especially in a volatile market like this one?
Well, diversification is it's the age-old wisdom of not putting all your eggs in one basket. In investing, that means spreading your money across different asset classes, sectors, and even geographic regions. This helps to reduce your risk and protect your portfolio from those sudden market swings.
So if one part of my portfolio takes a hit, the other parts can help cushion the blow.
Yeah, exactly. Think of it like this. If you had all your money invested in bank stocks right now, you'd probably be feeling a bit nervous after that JPM downgrade. But if you had diversified your portfolio, you might have investments in other sectors that are performing well, like tech or communication services, which would help offset those losses.
That makes a lot of sense. Diversification is all about balance and spreading the risk. But what about picking individual stocks? Any tips for navigating this current market, especially with all the post-election excitement?
Well, one of the most important things to remember is that investing is a long game. It's easy to get caught up in the hype and chase the latest hot stock, especially when the market is as dynamic as it is right now. But it's essential to stay focused on your long-term goals and make decisions based on solid fundamentals, not just fleeting trends.
So don't get swept up in the euphoria. Look beyond the hype. What are some things investors can focus on to make sure they're making smart choices?
One key factor to consider is valuation. Some stocks might be getting a little ahead of themselves in terms of price, especially those that have benefited from the recent election-driven rally. It's crucial to look beyond the excitement and dig into the company's financials.
So it's not just about buying what's going up, but also making sure the price is justified. What should we be looking at when evaluating a company's financials?
Focus on things like earnings growth, revenue trends, debt levels. These are the factors that ultimately determine a company's long-term value. It's like doing your due diligence before buying a house. You wouldn't just buy a house based on a flashy paint job, would you? You'd want to inspect the foundation, the plumbing, the roof, all the essential components. Stocks are similar. You need to look under the hood before you invest.
Great analogy. So we've got diversification, focusing on long-term goals and making sure the price is right. Any other words of wisdom for our listeners who are trying to make sense of this exciting but sometimes overwhelming market?
The most important advice I can give is to stay informed. Keep up with market news and economic data releases. Pay attention to the Fed's pronouncements and the potential impact of upcoming policy changes. Remember, knowledge is power, especially in the world of investing.
Absolutely. And there's so many great resources out there to help investors stay informed. Of course, we hope this deep dive is one of those resources, but there are also many reputable financial news sources, research platforms, and even financial advisors who can provide guidance.
Yeah. And one final thought I want to leave you with. Amidst all the market excitement and uncertainty, remember that investing is ultimately about more than just making money. It's about building a secure financial future for yourself and your loved ones.
Well said. Investing can be a powerful tool to achieve your dreams, whether it's buying a home, retiring comfortably, or leaving a legacy for future generations.
So stay curious, stay informed, and most importantly, stay engaged.
Until next time, happy investing, everyone.